Viewers, we continue with our revision for financial reporting F7, now called FRACCA. Today we will cover question 1 from the September-December 2015 exam paper. Let's go to the question. Required to prepare the statement of profit or loss and other comprehensive income for the year ended 30 June 2015, 11 marks. B. Prepare the statement of changes in equity for Moston for the year ended 30 June 2015, 4 marks. Note, the statement of financial position and notes to the statements are not required, 15 marks. Now, let's read the scenario. The approach that we are going to do today is we will first work out everything that is on the additional notes, then we answer the question. Then the scenario: revenue, cost of sales, research and development costs, distribution costs, admin expenses, loan note interest and dividend paid, investment income, equity shares, 5% loan note, retained earnings, revaluation surplus, other components of equity, property at valuation, plant and equipment, accumulated depreciation, financial asset, equity investment. The following notes are relevant, so we'll be doing the notes one by one. So we'll start with the note number 1. Revenue includes a 3 million sale made on 1 January 2015 of maturing goods which are not biological assets. The carrying amount of these goods at the date of sale was 2 million. Moston is still in possession of the goods, but they have not been included in the inventory count and has an unexercised option to repurchase them at any time in the next 3 years. In 3 years' time, the goods are expected to be worth 5 million. The repurchase price will be the original selling price plus interest at 10% per annum from the date of the sale to the date of the repurchase. Now, let's work it out and find out what it means. After 3 years, the market value of the goods will be 5,000. And after 3 years, the repurchase price will be the selling price of 3,000 multiplied by 10% for the next 3 years. So we'll say 1,1 to the power 3 like that. So the repurchase price will be 3,993, whereas the market value will be 5,000. So the repurchase price will be far less than the market value. So indeed, this is not a sale, but it's rather a loan. What we are going to do, we are going to reverse the sale, reverse the cost of sales. If we reverse the sale, we will include these goods in the inventory, right? So we will have to reverse the sale. How to reverse the sale? We will debit revenue in 1,000, that's 3,000. Then we recognize the loan. So credit the loan, 3,000. The carrying amount of these goods is 2 million, but it is not included in inventory. So we'll debit inventory, including them in inventory now, adding them in inventory. Then we will credit the cost of sales because this 2,000 or 2 million is included in cost of sales. So we need to reverse or remove it from cost of sales. So we are done with note number 1. Let's go to note number 2. Before we go to note number 2, as we said, we are recognizing a loan. We are recognizing it at what? At 10%, as this interest will be paid at 10%. So the loan will simply say the loan is for 3,000 multiplied by 10%. the loan is from January, February, March, April, May, June. So it's for 6 months. So we multiply by 6 divided by 12. So the finance cost of that loan is 150. Let's go to note number 2. Note number 2 relates to this research and development of 7,800. Moston commenced a research and development project on 1 January 2015. That is this year. It spent 1 million per month on research until 31 March. So January, February, March spent 3,000. At which date the project passed into a development stage. So the research phase, it has to be expensed. From this date, it spent 1.6 million per month. That is April, May, June. Another 3 months. At which date development was completed. That was what? 30 June. However, it was not until 1 May that the directors of Moston were confident that the new project will be a commercial success. So from the date that the directors are recognized that the project will be successful, that's when we will start to capitalize. But before that date, we need to expense everything as research expenditure. So we'll simply say 1,000 multiplied by 3, which is January, February, March, plus the April, because the directors were confident in 1 May. The April charge was what? 1,600 as development expenditure. But this development, the directors were not sure whether the project will be successful or not. Then from May, June, that is 1,600 multiplied by 2. This needs to be capitalized. So if we add this, we get the 7,800. But we need to expense the 4,600 and capitalize the 3,200. But we will not see the leg for capitalization as we are not doing the statement of financial position. We are also told that the expenses should go to cost of sales. So the 4,600 will add it to cost of sales. Let's go to note number 3. Note number 3 is non-current assets, relates to property and also the plant and equipment. Moston's property is carried at fair value at 30 June 2015 was 29 million. That is 29,000. The remaining life of the property at the beginning of the year was 15 years. So let's go to the property. The property at valuation, that is at the beginning of the year, is 28,500. We need to depreciate over 15 years. This depreciation will go to cost of sales. Then the revalued amount we are given here is 29 million. So it's 29,000 like that. Then now we need to calculate the gain or loss on revaluation. So the gain or loss on revaluation is 2,400. That will go to other comprehensive income. Moston does not make an annual transfer to retain earnings. So we are not going to amortize this revaluation surplus. We are not going to divide this by 15 years and take it from the revaluation surplus to the retained earnings. And also we are told to ignore deferred tax. So we are not going to include the deferred tax implications on that 2.4. The examiner was good at us here. Plant and equipment is depreciated 15% using the reducing balance method. So the reducing balance method, we need the carrying amount at the beginning of the year. The cost was 27,100 less the accumulated depreciation of 9,100. That is the carrying amount. Then we need to depreciate that reducing balance at 15%. We get that depreciation, then we calculate the carrying amount at the year end. Of course, we are not going to use this carrying amount as we are not doing the statement of financial position. Let's go to note number 4. The 5% loan note was issued on 1 July 2014, that is the beginning of the year, at its nominal value of 20 million. This is the 20 million that is shown there on the trial balance. Incurring direct issue costs of 500,000, which have been charged to the administration expenses. This is wrong. The issue costs, they need to be offset against the proceeds of the loan. So the loan amount was 20,000 less the issue costs. So the carrying amount should be 19,500. And this 500 that was charged to administrative expenses, we need to go and reverse it by reducing our administrative expenses by 500. Now on this carrying amount of the loan, we need to add the finance cost. We are told the finance cost, the effective rate is 8%. So say that multiplied by 8%. From there, we need to subtract the interest payments. How much should be the interest payment? The interest are paid at 5% of the nominal value. So it should be 5% multiplied by 20,000, like that. We get 1,000. If we sum everything, we get the carrying amount at the year end, of which we are not going to use that carrying amount. Let's go to note number 5. Note number 5 says, at 30 June 2015, the financial asset equipment equity investment had a fair value of 9.6 million, of which in thousand is 9,600. There were no acquisition or disposal of these investment during the year. So let's go to the trial balance. The financial asset is what? 8,800. So it has increased in value by 800. That is a fair value adjustment or the investment income that will add it to our statement of profit or loss. Let's continue to our note number 6. The provision for the year ended 30 June of tax is 1.2 million, of which is 1,200, like that. Together with the increase to the deferred tax provision, increase is a deferred tax movement upwards of 800, needs to be added to the current tax. In this instance on the trial balance, we were not given the under or over provision to adjust our charge to the income statement. So those are the final two. Now let's go to our last note, that note number 7. Moston paid a dividend of 20 cents per share on 30 March 2015, which was followed the day after by an issue of 10 million equity shares at their full market value of $1.70. The share premium on the issue was recorded in other components of equity. So we are, in this instance, it simply tells us that there was an issue of shares during the year. How much was issued? 10 million. So we'll say 10 in 1,000, 10,000 multiplied by $70. We get 17,000. So what it means is these equity shares of 30 and also the other components of 9,300, they already include, because these are the values at 30 June 2015, they already include the share issue during the year. So we need to split that share issue during the year. So we'll simply say how much was issued, 10,000 multiplied by dollar. This dollar is here, the nominal value. Then we'll simply say 10,000 multiplied by the premium of 70 cents. We get 7,000 like that. So at the beginning of the year, we'll say 30 minus this additional 10,000. So we began with 20, we added 10 to get 30. As well here on the other components of equity, we did not begin with 9,300. We began maybe with 2,300, we added 7,000 to get it 9,300. Then how much was the dividend paid? The dividend paid was before the issue. So the dividend was paid on the shares before the issue. So how many shares were there before the issue? After the issue there are 30, but the issue is 10. So before the issue we have got 20. So we'll simply say 0.20, that's 20% or 20 cents, multiplied by bracket. The number of shares is 30,000 now, but the shares that were issued is 10. So it means 20% of 20,000. So the dividend now that is paid is 4,000. So if we go to our statement of our trial balance, we have got loan interest and dividend paid of 5,000. This 5,000 is made up of this 4,000 plus the interest of 1,000 to make it 5,000. We have worked everything that we need to work out. Now let's answer the question. The question says, prepare the statement of profit or loss and other comprehensive income, and also prepare the statement of changes in equity. So the statement of profit or loss, we start with revenue. Our revenue is 113,500 as per the trial balance. Then we need to less this 3,000 that we debited here. We get 1110. Then the cost of sales, we have got the 88,500 here. We need to less the 2,000 that we reversed here. We need to add on that cost of sales, we need to add the research expenditure that is expensed as we were told here. We also need to add the depreciation charge, as all depreciation should go to the cost of sales. Nothing needs to go to the cost of sales in our workings. Then we have our cost of sales like that. Then we can now sum up to get our gross profit. We have our gross profit. Then we go to our trial balance. Distribution costs, 3,600. Admin expenses, 6,800. But we said we need to take off the 500,000 that loan issue costs that needs to be capitalized. Then we've got investment income. Investment income on the trial balance here, we've got 300, but we said we need to add again the increase in the equity investment of 800 there. Then we have our finance cost. Our finance cost will start with our loan interest on that sales that we said the loan is for 3,000. Then again, we need to have our finance cost on the loan note and nothing more. Then we have our tax. We need to subtract our tax here. We have calculated it as 2,000. Then when we sum up everything, we should get our profit for the year. Then gain on revaluation, We have already calculated our gain on revaluation here. When we sum up everything, we should get total comprehensive income. This is what was expected from us for 11 marks. Then let's march on and take again our 4 marks that is left. Our 4 marks that is left for the statement of changes in equity. Here we are seeing 30,000, but during the year 10,000 was issued. So we started with 20,000. Other components of equity, we have got 9,300, of which during the year 7,000 was added. Retained earnings, it's 6,200. Revaluation surplus, we have got 3,000. Profit for the year affects retained earnings. Revaluation reserve is affected by the gain on revaluation. We have already calculated our dividends here as 4,000. The dividend paid affects our profit. Then our shares, we have calculated these figures here as 10,000. And other components, we calculated the figure as 7,000, like that. Then we can sum up everything. This is what was expected from us to get our 4 marks, totaling all in all 15 marks. Please guys, watch this video until the end, and also if you are new to my channel, please subscribe to support the channel. Thanks for watching.